Hello everyone and welcome back to my channel. Today we are diving into the state of the US economy in 2024, focusing on three key factors: the Economic Surprise Index, recession risks, and the US debt rate. I'll be breaking down what these indicators mean, how they compare with recent years, and what direction the economy is heading towards. Let's get into the facts and analysis. The Economic Surprise Index, or ESI, measures how economic data compares to market expectations. When economic data comes in better than expected, the index rises, and when it underperforms, the index falls. In 2024, we've seen mixed signals. In early Q3, the ESI hovered around positive territory, signaling that the economy was outperforming expectations. However, volatility in global markets, including trade disruptions with China and rising oil prices, caused fluctuations in consumer spending and inflation expectations. According to the latest data from Citigroup's Economic Surprise Index, the US outperformed expectations through mid-2024, with significant contributions from sectors like technology and services, which managed to maintain resilience despite global uncertainties. The key takeaway here is that the US is still showcasing strength in certain sectors, but it's not without challenges, particularly from external shocks. There's been a lot of talk about a potential recession, especially following the rapid interest rate hikes by the Federal Reserve in 2023 and early 2024. While the Fed paused hikes mid-year, many are asking, are we already in a recession or is it looming? So far, there hasn't been an official recession in 2024. The labor market remains tight and GDP growth, while slowing, hasn't contracted. Economists are divided on whether the US will enter a recession by 2025, but several factors suggest a slowdown. The latest unemployment rate stood at 3.8% in September 2024, which is still relatively low historically. However, real wage growth has stagnated and consumer confidence has shown some declines in recent months. The Conference Board's Consumer Confidence Index dropped from 108.7 in Q2 2024 to 104.1 in early Q4, reflecting growing uncertainty among consumers. The key takeaway is that while the US is not in a recession yet, the risk remains elevated due to slowing consumer spending and the lingering effects of the Fed's aggressive monetary tightening in prior years. Now let's talk about the elephant in the room, the national debt. As of 2024, the U.S. national debt has exceeded $33 trillion, with interest payments alone costing hundreds of billions each year. This growing debt is driven by persistent budget deficits, partly due to pandemic spending and tax cuts that have outpaced revenue growth. The U.S. debt-to-GDP ratio is projected to hit 123% by the end of 2024, up from 121% in 2023. The Congressional Budget Office, or CBO, warns that if this trend continues, it will increase the risk of higher inflation and interest rates, making borrowing more expensive for businesses and consumers. While the debt situation hasn't triggered a crisis yet, it raises long-term sustainability concerns, especially if interest rates remain elevated and economic growth slows. So where does this leave us? The US economy is performing better than expected, but volatility remains. Recession risks are not off the table, but the US is not there yet. The growing debt remains a critical issue. Sectors like tech and services continue to perform well, and the labor market remains resilient. Subscribe, and hit the notification bell for more updates. Thank you for watching, and I'll see you in the next video.